Welcome to Chapter 10, the money supply process. First of all, I want to say that the book PowerPoints are not very good. So I've supplemented them with PowerPoints from another source. So this chapter is a bit choppy, a bit like the last chapter, just because I feel that the material from the PowerPoints for our textbook are not up to snuff. So I will be chopping in and out from other material, but this other material is exactly the same material as presented in the text, with some minor differences, but at any rate, I think it's just a better presentation. So first of all, we start off by thinking about what is known as the monetary base. Now, the monetary base is incidentally sometimes called M0 or high-powered money. And monetary base consists of currency in circulation plus the bank reserves plus the US Treasury currency in circulation. So this is coins, of course, in the case of the US. In other words, essentially currency plus reserves. So some people write this as MB equals C plus R. So $1 change in the monetary base results in the money supply increasing by more than $1. Why? Because of the process that we looked at earlier, whereby a dollar comes into the economy. As long as that dollar gets banked somewhere, then it adds to the liabilities of the commercial bank, but that commercial bank can then turn around and lend that dollar out after putting, of course, the minimum reserve requirements aside, and then that circulates through the economy, etc., and gets deposited into another bank, etc., etc. So that's why this is called high-powered money. It's the basis for which the on which the multiplier works, I should say. So notice this is not money supply. Money supply, if we're looking at M1, would be C, currency in circulation, plus D, bank deposits. So money supply is a measure. Monetary base is kind of what the central bank can control, which then multiplies up to create M1, as we're going to see in this chapter. So how does the non-bank public, by the way, whenever they talk about non-bank, they mean not, private sector, but it's not a bank. So how does the private sector, basically, apart from banks, affect the monetary base? Well, the non-bank public can affect the monetary base in a variety of different ways. For example, what might stop that dollar that goes into circulation being deposited in a bank is if someone decides, heck, I'm going to keep that dollar as cash. So how much cash the general public wants to hold? And that would change the composition of the base rather than the size. So, in other words, it doesn't really matter what the general public does in terms of its holdings, but that can change the composition of the base, as we're going to see. You'll see how this pans out. Now we're going to move over to the content from the other book, because basically we need a framework here. Now the framework is offered in Brandl, but he doesn't really use it in his PowerPoints anyway to the extent that this other textbook does. So there are three players in the money supply process, three actors if you like. There's the central bank, there are banks, and there's depositors. So basically there's those three actors, if you like, in this drama or play. And let's look at the Fed's balance sheet. The Fed's balance sheet consists of of course, drawn like a T again. So we have assets on the left-hand side. That's what the Fed has. And liabilities, that's what the Fed owes. So the first thing that the Fed owes is, of course, reserves. I'll go through that. I'll put that first, second in the actual table, but I'll put that first. So that's the obvious thing. Reserves are obviously just the amounts that commercial banks keep with the Fed. So the Fed owes those amounts really back to the banks. Second thing in terms of liabilities, though, are the notes that the bank issues, the Federal Reserve banks issue. Why? Because officially those are Federal Reserve banks. They have value because the Fed says they have value. And we could go to the Fed and ask for something else to replace those, like gold, for example. And indeed, under the gold standard, that's what the Fed had to do. It had to come up with whatever backed the money that it issued. Now, on the asset side, the Fed, of course, can buy government bonds, and it does. So it has securities. And it also, through the discount window, makes loans. So that's loans to financial institutions. So let's look at the first form of monetary policy. What happens when the Fed makes an open market purchase? Remember, this is when the Fed buys a bond from a bank. So on the left-hand side, you see the T for the banking system. The right-hand side, you see the T for the Federal Reserve. So the Fed goes out, it buys a bond. That means the Fed has basically bought a government bond, and it owns now more government bonds. So on the asset side, its securities have gone up by 100 million. Of course, it has to pay the bank that it buys that bond from, so that it has to credit into the account for the bank. So you see that as the liabilities of the Fed increasing by 100 million. What's happened in the banking system, though? Well, from the banking system's point of view, all that's happened is that the banks now own less government bonds than they used to, but they have more reserves with the Fed. They've got 100 million more reserves. So what's happened so far? Well, remember that currency here isn't affected because there's nothing happening there. But reserves have increased by 100. Remember that the monetary base is equal to the currency plus reserves. So monetary base has gone up by 100. Why has it gone up by 100? Because those reserves can now be lent out by the banking system. So the monetary base has risen by 100. So let's say the Fed doesn't buy from a bank. Instead, it buys from a person. So basically what the bank does is, the Fed does, is it goes out and it buys a bond from an individual. When it buys that bond from an individual, it has to write a check. So it writes the check to that individual goes to a bank, deposits the check. So you can see on the left-hand side, the banking system's liabilities go up by 100 million because their checkable deposits go up by 100 million. But of course, that means the left-hand side of their T and the banking system has to go up by 100 million because they have more reserves. Notice that this means that the monetary base, currency plus reserves, goes up by 100 million. We have an identical result as the open market purchase from a bank. In other words, when the Fed makes an open market purchase, it doesn't matter who it's from, monetary base will go up by 100 million. Now, if instead that person cashes the Fed's check and takes the cash, says, I'm going to hold this in cash, I'm going to cash the check, well, then the bank basically has to pay the 100 million. So that means the Fed now doesn't have those reserves as a liability. Instead, it has 100 million extra as liability. when you look at the non-bank public, the liabilities haven't changed because the individual deposited the check and then cashed the check for cash. So what's happened here is that the assets of the non-bank public have gone down by 100 million, and currency has gone up by 100 million. Obviously, that's that individual. So this isn't a bank in this case. It would be the individual, obviously a very wealthy individual, because they've got 100 million in bonds to sell to the Fed. Let's now think about this in terms of the monetary base. What's happened? Well, monetary base is currency plus reserves. Reserves haven't changed in this instance, but currency has gone up by 100 million. So the monetary base has gone up by the same amount, 100 million. So now you can see it doesn't matter who the Fed buys that bond from, and it doesn't matter what happens to that money that the Fed has to pay, whether it just goes to the banks, if it buys from the banks, goes to an individual, and the individual keeps the money in a bank, or the individual cashes the check, takes the money out as cash. It doesn't matter. Monetary base goes up by the same amount. Now, if we have an open market sale, that's where the Fed, of course, instead of buying bonds, it's selling bonds. That's going to contract the monetary base, obviously. So we should see exactly the opposite happening. So the monetary base would contract by the amount of the sale. In this case, we have an open market sale by the Fed for cash. So the Fed is selling government bonds and it wants to be paid in cash. So the non-bank public, they've got 100 million more of treasury bonds, but 100 million less of currency, of cash. And you can see that figures also just the opposite signs that were from what we had before on the Federal Reserve System T as well. Notice that when the Fed actually does the open market operations, we're not sure what happens to reserves, but we are sure what happens to the monetary base. So the monetary base is a lot more linked to actions by the Fed, the tools of monetary policy, than it is reserves, than our reserves. So let's look at what would happen if the general public wants more currency and less deposits. So, for example, what happens at Christmas? So let's say, let's look at the 3 T's here. Let's look at the banking system. It's the one on the upper right, upper left, non-bank public, and of course the one below is the Federal Reserve System. So let's have a look and see what happens to the monetary base. So say the general public decides it's Christmas and they want to transfer some deposits into currency. So what are they going to do? Okay, so they're going to take some of their money out of the bank. So that means the liabilities of the banking system go down by 100 million because they have less checkable deposits. Some people have come and taken their money out of the bank. It means reserves, though, of the banking system have gone down by 100 million. Why is that the case? So that's on the right-hand T. On the left-hand T, you can see it's because basically the non-bank public, so people, in other words, have reduced their checking accounts by 100 million, and they've increased the amount of currency that they hold by 100 million. What implication does that have for the Federal Reserve? Well, if there's 100 million more now out there with the general public, that's the currency in circulation has gone up by 100 million. But of course, the reserves on the liability side of the balance sheet for the Fed have gone down by 100 million. So now let's have a look and think about monetary base. What's happened here? It's currency plus reserves. Well, you can see on the right-hand side of the Fed's balance sheet, so that's liabilities column, The currency has changed by plus 100, reserves changed by minus 100, the monetary base is unchanged. Why is that? Well, remember what the monetary base is. The monetary base is kind of the things that the Fed changes in order to change the money supply. So the fact that the public's come along and just changed what they hold, so instead of holding checking accounts, they're holding currency, all that's done from as far as the Fed is concerned is just the general public swapping between the assets they want to hold, but it hasn't changed the Fed's monetary stance, if you like. It hasn't changed. The Fed hasn't done anything in the marketplace to do an open market operation or offered more loans through the discount window or anything like that. So there's nothing changed in terms of the monetary base. Now let's have a look at the discount window. So what happens when the Fed makes a loan through the discount window? So a bank comes along to the Fed and says, we want to borrow some money. And the Fed says, okay, we're going to give you a loan. So the Fed gives that loan. And there you can see on the right-hand side, let's start off with the Federal Reserve System balance sheet. You can see that loans go up by 100 million. What does the Fed do with that to give that loan? Well, it just simply increases the bank account of the commercial bank with the Fed by 100 million. So you can see the Fed's balance sheet just goes up by 100 million. What happens in the banking system? Well, they've taken out 100 million of loans from the Fed, so their liabilities go up by 100 million, but on the other hand, they have 100 million more of reserves now. So that's gone up. So let's look at this from a monetary base point of view. Monetary base is reserves plus currency. So we can see reserves have gone up by 100 million. So that's what the monetary base goes up by. What are the other factors that affect the monetary base? Well, the float. What's the float? That's the amount that's payable to the Fed minus the amount that the Fed has paid out. That's going through the system. Hasn't cleared. In other words, it's checks clearing, etc. Treasury deposits at the Fed. When the Treasury deposits money at the Fed, things like during tax season as well, the Fed has to kind of offset that in terms of its own balance sheet. And then interventions in the foreign exchange market, which the Fed keeps an account for the government to go in if it wishes to, and purchase or sell dollars on the foreign exchange market for other currencies. Now, I'm going to stop it there for part one. When we get into part two, we're going to be looking at deriving a more complicated and more complex money multiplier than you've seen before. So I'll do this kind of math part in the second part.